Hi, my name is Alex Carlucci. I'm with Dustin and Gustin Cho with Gustin Cho Associates. And today we're going to talk about down payments for each type of program and closing costs for each program and how you can use closing costs to buy down your rate, pay your closing cost, and maybe even do a down payment assistance, get no money down on your purchase. So I want to start off. I'm going to do the best I can because it's very complicated and there's some banks that are opening up the rules a little bit and changing it, but I'm going to go off the old traditional standard for now. If you want to do a conventional loan and you're a first-time home buyer, and that means you haven't owned a house in 3 years, so you could have bought a house 5 years ago, sold it 5 years ago, and you're still considered a first-time home buyer, you can do 3% down. And on that, you can ask for 3% closing cost credits. We'll get back to that, what that means, what 3% is a closing cost credits and why. If you are not a first-time home buyer, the lowest amount down you can do is 5%. And all the way up to 20%, you're going to have what's called a private mortgage insurance. And you can get 3% closing cost credits from 3% down all the way up to 20%. Well, actually, I take that back. Up to 10%, you can get 3% seller credits. Over 10%, you can ask for 6% seller credits. And over 20%, I believe you can ask for 9% seller credits, but I want to double check that. This is for owner occupied. If you want to do an FHA loan, you can ask for 6% seller credits, and you can do as little as 3.5% down if your credit score is above 580, and 10% down is a requirement for the down payment if your score is below 580. And again, for 6% all across the board for closing cost credits for FHA, no matter what you put down. The VA is a little more unique. No money down is required. There's some unique situations where you could put 10% down to make you eligible for a second VA loan where you're moving away and you don't have rental experience and all sorts of weird things like that. But I'm not going to get into that one because it's very rare. But VA is no money down 99.9% of the time. And the closing cost credits are 4%, but there's a little trick to VA. So let's say you have 4% seller credits to go towards your closing cost. And let's say that the loan's costing 3 points because you got a bad credit score. You could actually ask for the 3 points for those points to buy down the rate and 4 points for your seller credits. You also can ask for additional seller credits above the 4% for VA if you're paying off debt to qualify and the seller agrees to pay that. So VA is traditionally 4% just for traditional closing costs. You can go over that if you're paying bona fide discount points or credit cards to qualify. USDA follows the conventional rules, I believe. I'm not a USDA specialist. If someone wants to chime in a little bit, they can. On investment properties, it's either a conventional loan or non-QM. So investment properties, on a regular conventional, the lowest we go down to is 15% down. But right now, you're not going to get any pricing that's even doable. It's going to cost 10 points. Can't do it. But in the good old days, you used to be able to do 15% down investment. 20% is okay. 25% is traditional for an investment property to get a good rate in this environment that we're in. Closing cost of investment for conventional is 2% on investment loans. Jumbo loans is, we have a 10% down on a non-QM. The traditional ones have gone to 15% down. They used to do 10% down about 6 months ago, and they all changed to 15% down. But on a non-QM, we could still do a 10% down. Traditional jumbo loans is also a 2% seller credit. When it comes to non-QM, that's where it gets a little messy. We have all sorts of loans, but the lowest down payment we offer for any non-QM product is 10% down. That's a full doc or a bank statement loan. You cannot get 10% down for a DSCR, which is an investment property. We do have some 15% down options, but very hard to get those done for investment on non-QM. When it comes to non-QM, we have some investors who are doing 6% on investment. They'll all do 6% on owner occupied. A lot of our non-QM lenders stop at 3% or 2%, sorry, 2% for investment. Now, who wants to chime in and correct anything I said? Because there's a lot going on there.
Okay, I'll
you
chime
really
in.
did. Go ahead.
Let me chime in real quick, okay? Let me explain, Alex. Great tie, by the way. Okay, where'd you get that? I like that. But anyway, I'm joking. But anyway, real quick, what is a first time home buyer? Okay, let's specify on that. There's two topics I want to talk about. Okay. First time home buyer is somebody, a renter, somebody that never owned a home, of course, as a first time home buyer. But you can be a prior homeowner and still be a first time home buyer as long as you have not had ownership in a home in the past 3 years, in the past 36 months. Then you can qualify, for a first time home buyer, the 3% down conventional. Okay, that's, let me just clarify that because a lot of people don't know, what a first time home buyer is. Okay, so number two is, let me explain what seller concession is. Seller credit, seller concession. All right. Okay. I mean, Alex, I know you're used to this, but you have to assume that a lot of, our viewers, they don't know what the hell you're talking about. All right. So, well, with that said, is this, let's take an example. Why would a seller give seller credits, okay, or pay for a buyer's closing costs? Why? Okay. Well, it's not going to really cost them anything. Let me just use an analogy. Let's say a home buyer wants, it's $100,000 home. Okay, he wants not even a penny less than $100,000. Okay, I'm using $100,000 because of just to for illustration purposes. That's it. So that's fine. FHA allows 6%, $6,000. On a $100,000 a purchase, 6% is $6,000. So does that mean that the seller is going to give up 6%, $6,000 of his profit? No, it is not. What we do is we structure the purchase contract at 106, $106,000, so that the seller gives seller contribution or seller concession of $6,000 for the buyer, the home buyer's buying cost, and the seller still gets their $100,000, okay, what they wanted, not a penny less, okay? So I just want to clarify that because a lot of people, I mean, Alex is talking a lot about, 2%, 3%, 6%, 9%, seller concessions. So I just want to kind of make sure that everybody knows that we're all on the same page, okay? So, but anyway, I think I'm pretty much done with that, so.
Okay, Gus, I got a scenario for you that I want you to answer. So this comes up, it seems to come up a lot, where I've actually have one right now that this is happening, where the house, the appraisal's been done, but they walk the house, the buyer walks the house and finds issues that they don't like. Maybe there is not necessarily a broken window, but let's say that one of the windows doesn't open properly. There's a seal issue. They don't have deadbolts on the back door, things like that. Where do you see that the buyer can negotiate price to make those fixes themselves? Any fixes that they see that they want immediately done? What do you think about those scenarios? Do you have an idea of what the buyer can do and how do they communicate with the seller with that?
Well, the bottom line is everything.
Yeah.
Okay, well, go ahead. Yeah, go ahead.
Yeah, I'll tell you, this is when it comes to FHA or VA, if you mention repairs on a contract, you're shooting yourself in the foot.
For sure.
Then the underwriters say the seller has to fix it before you close. And I've had some buyers go in and fix it themselves before they close, but they're fixing a house that's not theirs and the deal could die and they could be out all that repair money. But
right,
you can always negotiate repairs money, but you never want to put it on a contract. I always tell my clients, realtors, just don't put it on the contract. Ask for $2,000 seller credit from the stuff from the inspection, but don't mention it. That's what it's for. Just say it's for closing costs and not for all these repairs. You never know what the guideline is or what some weird underwriter is going to hang you up on and say, okay, fix that first. That's a major issue. Sometimes I thought something wasn't a major issue and it turned out to be a major issue. So I would always never tell them to do the closing cost credits for repairs if we are going to get some inspection report repairs done after the fact, because it just opens a can of worms.
Yeah, totally. I completely agree. And that's why I brought it up, because that is actually very, in my opinion, it's very common. Things that the buyer doesn't like, or a door sticks or something like that, and they just get caught up and they're like, you know, they think that they can push the seller because the seller's desperate to sell, and it does come up. Literally, we're working on one right now that is the exact thing, and that's exactly what our lead processor and myself are talking about. And we're like telling everyone, be quiet, easy, don't bring that stuff up. And that's exactly what we're doing, is finding a way to make it doable for both sides, but not bringing it up. Nothing against underwriters. We just, as LOs on our side, the underwriter is, I don't know, it's kind of the bane of our existence, honestly. So we're doing everything we possibly can.
Dustin, the bottom line is this, you know, when you see a case like that, remember, you know, if this is a home inspection that comes up, I won't order an appraisal, because from what you're saying, this might not even pass, you know, FHA or VA appraisal. You know what I mean? Possibly, you know, you understand what I mean? Now, I've seen a lot of cases where, you know, the seller says, you know what, even though it's not going to pay us a FHA appraisal, I'm not going to do it. I'm not going to fix it. I'm not going to spend a single penny on it. There's cases like that come up where the buyer wants a house so bad that they will do it over the weekend with the you know, the homeowner's you know, permission, and they'll come out of cost. So, you know, that's a great question, by the way. It will come up. There is no set rule that this, you know, who pays or not. It's up to both parties to come to a compromise. Depends how bad the seller wants to sell the house, you know, for the buyer, you know, how bad the buyer wants to buy the house. You follow what I'm saying? So, you know, just in general, the right-hand rule is the seller should repair all that stuff. Remember, you are not going to pass a FHA appraisal if you know, for safety, security, and it's got to be habitable. Okay, those are the three common rules. Okay, so you know, and the thing is this: the bottom line is this. Okay, everything's pretty much negotiable. You know what I mean? So
that's exactly the reason I brought this up, is to finish it and say that's exactly why you want a loan officer or a company that, like Gus and Cho Associates, like ourselves, that understand what that entails, so you don't get tangled up in a bunch of minutia that you don't need to be in. We try to make it as smooth as possible, the entire experience. That was what I was getting to.
So here's something that I want to bring up. So when it comes to closing cost credits, you can never credit more than the closing costs themselves. So if your closing costs are 10 grand and your closing cost credit is 11 grand, if at the end we realize that $1,000 extra does not go towards your down payment, it either gets lost or it gets renegotiated where they lower the purchase price, which complicates the closing.
Or you lower the rate, Alex, and they can pay for a more expensive rate and eat up those closing costs.
Yes, you could do that.
I just did.
Yes, but not down payment assistance. There's certain down payment assistance that you cannot buy them down the rate. So you know, Dale, that's exactly what we do. We don't let it go to waste. You know.
But there's a lot of different rules where you're gonna get burned because like the down payment system. But here on Dustin's problem, if we set this thing up where we got this thing calculated just right and we're using max credits, and then the inspection comes out and they want more repairs, you can't get more repairs credited unless that borrower's got that extra money that's going to eat into those credits. So if you've already maxed out your closing cost credits, thinking this is going to pay their closing costs exactly, they got exactly the down payment left over, and now you need additional credits, you can't get those additional credits in your case, Dustin, because you've maxed out. And it can't come from any magical way. Now, on the VA loan, you might be able to get something done like that. Dale's probably more of a specialist on getting more than 4% solid credits. I'm not sure if that could go towards, I guess, anything else, Dale. Could it? I don't know. You've done more
I
of those.
think you mentioned the main two. I mean, a lot of realtors will say to me, well, you can't go over 4. I go, well, yeah, you can. If the rate's costing 3, you can get 7 total, right? You can get 3 for the discounts, 4, like I said, paying credit cards off. But VA, you can get, actually, I haven't gone as deep in the weeds as what I've read in the guidelines, but you can get pretty creative in there.
Right. So let me describe.
It relates to seller closing cost credit.
Yeah, let me describe to the consumers out there about what I'm seeing that's going on. I'm going to start with an FHA loan because it's nice and easy. My borrower's got, let's say it's a $200,000 loan. Let's say the closing costs are going to be $7 grand. but their rate's going to cost 2.5 points because they got a 610 credit score. So it's going to cost $7,000 for closing costs, but it's $200,000 loan. So it's another 2.5 for the rate. That's another $5,000. So it's $12,000. I need the full 6% to cover the 2.5 points plus the $7,000 closing cost, the traditional ones that everybody would have. And they only have exactly the 3.5% down. Now, that's a situation where I'm fitting people into that tight of windows where if they don't get that full 6%, I'm not going to close a loan. And I write these pre-approvals. I call the realtors. They go, "Who are you? Why do you need 6%? Are you ripping the customer off? What's going on?" And I'm like, "No, they have a lower score. They need all these to pay the points, and they keep begging me to lower those points. That they're never going to get them out there in this environment." And they just push me really hard. And I've lost some deals because they found someone else to, like, maybe someone else to say yes. And I think that the loan falls apart somewhere else because they don't realize what's going on. But that's how delicate these loans are. And that's how hard it is to get them approved when they have those points they have to charge. And I need max seller credits, and there's no ands up for buts unless the borrower can get a gift from a family or save money. There's no options for my borrowers. Now, when it comes to the discount points on an FHA loan, those 2.5 points, we can't charge that borrower. Let's say they had $1 million in the bank and they wanted to do no closing costs. I still need those 2.5 points closing costs because FHA's got a regulation where things can't exceed high cost more than 5% of the loan. And the commission that the bank pays us, the MIP that goes towards FHA, which is an FHA charge, along with some other title charges and appraisal fees, can't exceed 5%. And based on our commission, our company's commission, not personally my commission, but our company's commission, the FHA's charge, and along with these other fees, we're always exceeding 5% without any points almost. So we're right there up against that 5%. So 1 point will make you fail that high cost thing. So you always need to get these points credited. And all the loan officers out there on our team, remember that you're submitting a loan that costs points. You better price that loan before you submit it. And you better get those points credited on your contract and know what your cash to close is, what can be credited, what can be paid by the buyer before you write that pre-approval and make sure it's structured. Otherwise, your deal's doomed at submission. It's going to be doomed.
Right.
So you have to know all of that. You have to see the very end and know what that closing disclosure look like, know what those points are, know what they have in the bank, know what's required by the underwriter, all at the beginning, and hope you get it right, because that's really, I tell my customers to know what the cash to close is at the end. I'd rather tell them how to fly to Pluto on a spaceship. That math is easy compared to what your cash to close is.
Right.
For us,
that is exactly that comes up every single time. So as a consumer, sometimes the consumer will, I'm not going to say they get upset, but it's just constantly like, what are my closing costs? What are my closing costs?
Right.
What are my closing costs? And honestly, look, we've calculated out as best we can, but I do not want to hand that number out until the very end. And even when you see the CD, which is the closing disclosure, it does. It absolutely changes. So you just got to kind of prepare the client. And for you consumers out there, when you have a loan officer who is hesitant to give you a final cost, it's not because they're trying to jack you on points or they're trying to make extra commission. It's because the deal is so fluid that it's still being structured until the very end. And so we'll give you a general ballpark. That's what I'm willing to do, is give you a general ballpark. But I always preface it with, understand, we are still moving through this process. And once again, that's why it's so important to have an LO that not only you trust, but is going to be as honest as possible as they can with you. And they're not trying to hide anything from you. A good LO is keeping you in the game and trying to make it fluid the whole time. But there are things we just don't know until the very end.
Let me say something to that. Loan officers make a fixed commission on every single loan. They can't make more. They can't raise fees and make more. We are regulated. We're like the prisoners, and you're like the king of the kingdom. We're the peasants outside the castle, and you guys can have our head chopped off if you want to, because they don't like us. The regulators hate us. You guys are protected as consumer. It's just that complicated. We can never get it right. I tell my customers, I go, it's a horrible process. I'm sorry. If someone told me to go buy a TV set at Best Buy, and they say, I go, I like this TV. And I say, how much? And they say, go stand in that 6-hour line. They'll tell you there, I would never buy a TV set. When it comes to buying a home, it's the nature of the beast. It's a horrible process. And all we can do is give you, I call it a guesstimate. They call it a loan estimate. It's a guesstimate. Nobody knows. And when people are shopping the loan officer with these loan estimates to compare cost, I really hate this because I've had realtors steal my deal away because we're only estimating B through whatever, K, I don't know what line items. The only thing we have anything to do with was box A, that is the rate, the points for the rate, the underwriting fee, if there's any processing fee. All the other fees are made up. And if that realtor wants their mortgage broker to be in control, all they do is have their loan officer beat in something in another section that we have nothing to do with it. We're just estimating it. And then they go with that person because they saved them $500 and they didn't, because those fees are going to be the same no matter what lender you go to. So when you're shopping,
Exactly.
for a mortgage, it's box
Yes.
A. You're shopping
Yes.
box A to box A. The rest of it's made up.
Yep. And a lot of times I've noticed in this career is that you will get brokers and real estate agents that they're not, I mean, let's be honest, they're going to pull the wool over your face and then you're not going to know until it's too late. And then you're at the end of the deal. And I've had people come back to me scrambling. Oh my God, Dustin, you were so truthful in the beginning and now I see what is going on. Can you help me now? And it's like, well, yeah, but now it may not be this home that we're talking about, because by the time we get everything moving, that rug might get pulled out from under you. So once again, it's find a group that you're willing to work with and then really do your due diligence. And once again, that's what I love about GCA is we have professionals in all different scenarios and we're all talking. So you consumers out there, that's one of the big advantages is that we're all talking to each other and helping each other and finding the avenues to get you the best deal.
Well, let me tell you about Alex, okay? He's got inferiority complex, okay? Just to correct our viewers, all right? Regulars don't hate us, all right? They hate Alex, okay? But I get along just fine. That's number one. And realtors are not against you, okay? Don't worry about seeing ghosts or, flying snakes or anything like that. We get along. Realtors and Alex don't get along, okay? I do, all right? But anyways, just want to correct that, all right? So...
Okay, Alex, did you see we have a question?
Okay. This is a question from McKevin. What are closing costs I need to pay when I do a VA Streamline refinance? So on a VA Streamline refinance, if you've got really good credit, we don't have to pay you, you don't have to charge discount points. Let's keep that out of it for now. You usually have just an underwriting fee. Let's just make it up roughly about $1,000. You'll have an appraisal fee roughly about $700. You'll have a tax certification fee of $85, a credit report fee of $25, a flood cert of $12. Then you'll have title charges depending. Now, when it comes to refinances, it does matter which bank you're using versus purchase because the bank picks the title company. So we pick the title company on refinance. $800 to $1,500, $1,600 on a refinance. It could be more if you're in Florida. In Pennsylvania, they got really high title fees. So picture about $1,500 for title charges, all in on a refinance when it's like $3 or $4 grand for a purchase, but a refinance is about $1,500. Then you're going to pay for an escrow for your insurance and escrow for your taxes. That's complicated because it depends on when your insurance bill is, the due date is. So let's pretend you're closing in September and your insurance, let's say you bought the house August 3 years ago, that means your insurance date is August every year, has to get paid. So if it was just paid, excuse me, then they're going to only hold 3 or 4 months in their escrow account. What they're doing with an escrow account is they're ensuring that every payment that you make after that, by the time August comes around next year, there's 12 months to make a 1-year payment, plus still a 2-month cushion in case your insurance rates go up. They never want to be chasing you for money. So they always have a little extra cushion in there. And the same with the escrow for taxes. Some states they pay taxes once a year, some are twice a year, some are 4 times a year. So it depends on the escrow date, when taxes were paid, and what you can do the math and add up the months, how many months left to go, and you can kind of figure it out that way. But we have a chart that tells us. But let's just say roughly 6 months escrows in your escrow account. Then you have to pay what's called interest per day. That's from the day you close to the end of the month. That's really just your mortgage payment. So if you close on the 15th, you have to pay 15 days of interest, no principal, just interest. And if on a $200,000 loan, I'm going to say that's about $30 a day. So that's $450. Now, here's the good thing with these escrow accounts. When you close on the mortgage on a refinance, on a VA, you are going to, let's say you close September 15th, you're going to skip October, you're going to
Yep.
pay November. And if your loan officer does it right, you don't have to pay September, but it's built into your payoff. You don't win. It just saves you money out of your pocket today. Your
Yes.
payoff's higher. So you can
Yep.
actually skip 2 months mortgage payments. And here's also the good thing. If you look at your current mortgage statement, the month you're closing in, add 1 month of escrow payments to that, you're going to get a refund from your lender for that amount back 30 days after you close. So you're
That's
always gonna get
exactly.
cash back. Yeah. So
Yeah,
usually,
that's a huge part. And another thing, like you were saying, that sometimes a lot of people, they don't even realize what that means on their mortgage statement. So you have to pull it up with them and say, okay, look at your mortgage statement, look at what your escrow balance is right now. Depending on what time of the year, again, that it is, that could have already been paid, because as we come to the end of the year, it needs to be paid. Another thing a lot of people don't understand is sometimes that escrow balance sitting there hasn't been paid, and it has to be paid by a certain time at the end of the year. It all has to be collected. So you really want a loan officer that understands what time of the year we're in, what's going on, and how it is. And then I always talk about, hey, you're possibly going to get an escrow balance refund, but we really need to take a hard look at that mortgage statement. That's why LOs that are doing refinances are always asking you for that mortgage statement right up front, the most current one, because we're starting to pre-game what's going to go on and what potentially is going to happen so that we can get the best deal possible for the consumer.
so there's, when it comes to that escrow refund, there's a lot of people, especially in these days right now, we haven't done any refinances in a while because rates keep going up, but
Right.
we're not doing a lot of those, but tax bills keep going up, insurance rates are going up. And what that's creating is not an escrow balance, but an escrow shortage.
Extra,
And what
yes.
what the current servicer's not doing to you yet, that's coming if it hasn't happened, is they're going to come after you and say, you got a $6,000 escrow shortage. We want that back in 6 months at $500 or $1,000 a month, or you can pay it all off right now in full. So that's going to start happening. That's a really high scenario. Usually it's like, $2,000. It's not $6,000. But anyway, what happens is when your taxes go up and your insurance go up, your escrow was set when you last purchased or refinanced your house at those tax bill rates and those insurance rates. And if they've gone up and it's been 4 years since you refinanced and they haven't updated your escrow account, you probably are of a shortage. So the good news is when you refinance, you can make up that shortage and it's not considered cash out of your home. So you can build that in, and a lot of people save themselves.
Yeah.
Some people save just a barely a little bit on a refinance just to pay that escrow shortage. Sometimes that saves people. Some people have no money in their bank, and that escrow shortage is $6,000. Yeah, they're saving up $50 a month, but that $6,000 is going to kill them. So they do a refinance just to catch up on the escrows. So sometimes you can have escrow shortages.
Alex,
keep that in mind.
Alex, I've never done a FHA VA streamline. Can you explain what happens with the upfront MIP or the VA funding fee when you do a streamline?
So the funding fee. So the funding fee, nothing really happens with the funding fee, but with the FHA streamline, if you bought a house, and I think it's 3 years, the clock starts ticking, but let's say you refinance after 6 months and it's called MIP. Let me describe what MIP is. FHA charges a 1.75% of the loan amount when you buy or refinance a house. If the loan amount is $200,000, that's $3,500. That's going to be added to your loan. It's the cost that doesn't get billed to your back pocket. It gets added to your loan and you finance.
Yeah, it's the upfront cost.
Yes. So if you refinance after 6 months, you can't refinance any sooner. It starts at 80% refund of that $3,500, but you get charged a new $3,500 or whatever 1.75 is your new loan amount, but you get 80% of it on the 6 month period and 78% the next month until it winds down to, I think, 10 or 15% after 3 years. Then you get nothing. It's all gone forever. But that's only for a refinance. If you sell the house, you don't get any of that back. So when you're doing a refinance, you have to do this calculation of what it's called a MIP refund is to offset your new one to help your cash to close to make this whole refinance work on a streamline. VA does not offer that.
Okay, now what if you do a full blown, rate in term refinance or a cash out refinance, but it's the same loan program? Do you get refunded,
Yes.
you
This-
know,
on an FHA loan, you always get that refund within the 3-year window.
all right, great. Learn something.
Here, I got another question. Harry Duke. What costs are sometimes overlooked when first-time buyers budget for the home buying process and home ownership? I'll tell you right now, a lot of things that overlook are
Points.
surveys. No, hold on.
For
Our
sure,
surveys.
100%.
Surveys are never calculated in there. That's a big one. Flood insurance is a blindsider. It's very rare, but you get flood insurance. But a lot of people aren't prepared for what their hazard insurance is going to be. We think it's going to be $1,200. Next, thing you know, comes in at $4,000 because they're buying in an area that gets vandalized, or they had 3 or 4 claims on their car accident in the last few years. So their insurance rate. So those are some unexpected costs that get
Water
overlooked.
tests, well
Yeah.
tests,
Yeah.
a lot. I mean, it can really, really get out of hand. It's funny because a lot of people are like, hey, I want to go, I see this great piece of property. It's 2 acres and I want to go live out. This happens a lot to me in Florida. And I've learned that it's like, oh, I want to go live on this 2 acres, but they've got a well, they've got a septic, they've got, and it's like, understand when that house sells, there's got to be a new water test if they haven't done a survey. And this is another one that people need to understand. If you are looking at purchasing, and I personally feel it's a good idea, is a modular or manufactured home, this is a key reason that you need to ask the question of the loan officer or that company, do you have a specialist LO that knows the ins and outs of this? Because it will start stacking up, and the fee after fee after fee.
Yeah.
And the hard part is you get to the point, well, this loan may not close and it may not be your fault. The seller may back out. You don't know what's going to happen. And then you go look at another modular home or a mobile home, and then it starts all over again. None of those credits come back to you. So it is very important that the LO understands what they're getting their client into and make sure that that goes as smooth as possible.
So a manufactured home what I was going to point out. What manufactured home is it's a mobile home that's been converted to a regular single family home where the borrower owns the whole property. They're not parking it in a lot, renting a spot.
Yes.
They own the land, and it's been permanently affixed with cement and all sorts of piping. And so it's permanently affixed to the ground. And that's what makes it a manufactured home. And the cost of that should be negotiated up front by the realtor, because I've had some games of chicken. Who's paying the $600 engineering report? You have to get an engineer to go out there and confirm to the underwriter that that thing's done right and properly. It's affixed to the ground properly, and that's $600. And I've seen people not negotiate that in the contract. And then when I say we need it, they look at each other, who's paying for it, and it's not in the contract. So it becomes a game of chicken. But that should be a seller cost. But I've had plenty of buyers pay for it. That could be a hidden cost.
And that's what happens when a lot of times the LO and the real estate agent don't communicate very well. And then the buyer comes back and is like, why am I being charged all these fees? And then it's this, the LO is like, look, I understand where you're coming from, but this should have been in the real estate purchase contract. This should have been negotiated in the very beginning between the 2 real estate agents, because we're on the back end. Like, I'm proactive with my buyers and really communicating with everyone involved to make sure that this is going right. But we're really not your real estate agent. We're the finance side. So that's when sometimes you need to ask your LO. I am a big believer in finding your LO and getting your loan first, get that pre-approval letter, and then let's go find a real estate agent and get a really good one. A lot of people are like, no, I'm going to use my sister. And it's like, okay, that's fine. But then they start barking back. The consumer does and says, hey, why am I getting charged all these fees? Well, actually, that should have been negotiated in the very beginning by your real estate agent. And then they're like, what? And then it just goes to them back and forth. So once again, I'm not trying to browbeat everyone and understand. I'm just saying that GCA, this is what we do. We make sure that we're communicating clearly and we're trying to get the best deal possible for our client.
All right. We got Harry who has a question. Can a first-time home buyer use multiple down payment assistance grants, loans on a single mortgage if their area has them and they all qualify? So I'm going to say no to that, but I couldn't tell you for sure. That's something I say, let me call you back. I'll call a rep. But most of my down payment assistance programs are specific to that bank only, and they only use theirs, and you can't use any outside people unless it's on an approved list. I've never seen them combine two separate ones, but I'm not saying that's not possible. I'm just guessing no. But if you really press me on it, I'd be calling on all day long until I found the exact answer.
I have seen like so one of the big lenders that we use, UWM, they'll have something like a 3% borrower smart program, where that borrower smart program, we can use that 3% and we can go to the city or the county if they have some sort of down payment program. That can happen, but you really need to know which ones are which. And the other thing is that I've gotten myself into is you find out that this county has a really good program, but when did that program come online? If that program came online 12 to 18 months ago, there may not be any funds in that account. So you really want to make sure. One of the things that I do with first-time home buyers is one of the first things I say is start communicating with your county and your city and finding those programs so that I can look into them. And a lot of times they want the LO to be approved through that program. And so if we get out in front of that in the very beginning, you could have a local program that's better than what the lender is offering. So it's important that you're communicating with us. We'll bring it up. Most times a good LO will be like, hey, you need to start looking at this. You're a first-time home buyer. Let's see what's in your area. And they'll do the research too. But we really want to get in front of that from the very beginning.
I want to discuss
Normally
one of
there's
go ahead, Gus.
yeah, normally there's it's twofold. From my understanding, Harry, is this: for the down payment assistance program, you normally have to use a 3.5%. And that's what the agency, okay, whether it's a city, county, or state. All right, it's not a federal, down payment assistance program. It's all individual. Now, with that said, it says the second type of down payment program is the closing costs. All right, your employer can offer a what is that, first time for their employees, or your employer, government agencies. So from what I've seen is, I don't think you can, again, I need to fact check this, I don't think you can split the down payment program where you get 2% from one agency, or 1.5% from another. Because if you look at these guidelines of the down payment assistance, is specific. Like you need a 680 credit score, or what the interest rate is this. So with the down payment assistance is one thing. With closing costs, I think is different. And I think you can use it, both different programs, but I don't think from my knowledge, I don't think you can split the original down payment. Like the 3.5%.
I've never seen where you can split it. I've never seen that, but you definitely can do the closing costs, and then the lender gives another sort of incentive. That's one as well.
All right, I'm going to tell you what my opinion on a down payment assistance. We have one investor that does a really good down payment assistance, and this is what it differs from all the rest. So every state issued down payment assistance program is basically the same. They put a lien against your title, and when you go to refinance in less than 5 years, it's usually a 5-year, you have to pay that off in full. If you sell or refinance in 5 years, you have to pay all it back. So if they give you 15 grand and you go to refinance and you're doing a rate and term refinance, now all of a sudden you have to bring 15 grand to the closing table. Where are you going to get that? Who's got 15 grand to spend at a closing table just to save $150 a month on a refinance? So that's one thing.
Or you end up doing a cash out because of it.
Yeah. Well, then you get penalized on the rate doing cash out. So
yeah.
I don't like most of the down payment assistance programs. If someone can get the money, I beg them to do it, and they get the seller to pay their closing costs. In a situation where you would need two, it would be $100,000 loan, because most, you can't get a lot of closing cost credits to cover the closing cost, and you can't get enough. It gets hard to get the right amount from our closing, or from a down payment assistance program, to cover all that because of the low loan amount. But that's the only downside about our down payment assistance program. If it's a decent sized loan, 200 and greater, we can get you to a house with no money out of your pocket, and in 6 months you can refinance that house to a better rate, no paying anybody back. That's the best one out there, because I think rates are going to drop. I think there's going to be a big refi boom. Why would you want to be left out of it because you owe 15 grand to your second lien for the down payment? You don't want to be stuck in that loan for 5 years and not be able to refinance and take advantage of it because you don't have that money. So if the property value goes down and the interest rates go down, FHA will do a streamline for you. If you've got that second lien out there, now you can't do a streamline because you owe that 15 grand. You can't do a cash out because your property value fell down. So I think there's a possibility that rates are going to go
All right,
down
hey,
without values going up.
Yeah.
Without the values going up,
Okay,
so you cannot incorporate that.
Right. All right, let me interrupt. Okay. All right, Nostradamus. Let me ask something. I know the down payment assistance program you're talking about. Okay, so basically it says they'll cover 3.5% down payment on an FHA loan. And
Your phone's breaking up, Gus.
This
Your phone's breaking
program.
up, Gus.
Okay. All right. I hear you. Okay, listen. The thing is the 6% seller concession you need for the closing costs. What if the property doesn't appraise out? What happens then, and what kind of solution you have, Einstein? Can you explain?
Wait, that's the question again?
Yeah, ask that question again.
Okay, what I'm saying is this. I know the program you're talking about, the down payment assistance program with Christian, right?
Yeah.
Okay, 6%. Okay, this has to be borrower paid. Okay, explain what borrower paid is, number one. Number two is, okay, what happens if the property doesn't appraise and they have to adjust the seller concession? What happens on cases like that?
Well,
Then
you better hope. Okay, so let's use an example of a $300,000 house, and you got a 6% seller credit. That would be $18,000. Now, 2.75 of that percent, or roughly $9,000 or $8,700, is going to be your down. Is what the bank is charging you to pay our commission and to give you the down payment. So the 3.25% left over, which is about $9,500. I'm not doing exact numbers here, or 80, whatever. And then that goes towards your closing costs. So let's pretend that we calculate your closing costs as being exactly whatever, 9,500, and your down payment is going to be 8,500. We got this all squared away and it's all perfect. And also the appraisal comes in $50,000 light. Then now you need to bring $800 to close because your closing cost credit went down by 1,500 or whatever. So now we're short, giving you all the credits you need. You're going to be in a position where you're going to need to get some gift funds. There's no way around that. Nobody can credit that money to you. That would be a problem.
Right. Hey, Alex, you see we have another question.
Yep, Louis, does the government give first-time homebuyers tax credit in this high interest rate mortgage rate environment to truly help in the buying of a home? I'm not really sure what kind of tax credit. Gus, your phone's not working. Put your aluminum hat on. Gus?
Energy financing. Yeah, can you hear me? I'm sorry.
Yeah.
It's T-Mobile. Don't blame me.
So he's talking about like solar, like if you're going to buy a greenhouse, that the government will help put the money down. So that's probably the only situation where I could see that they're going to help you. Is if you buy a greenhouse, there's some green lenders out there that'll help get you into it. But the tax credit, I'm not sure what you're looking at. I don't understand. Can you clarify? Or does Dustin, do you know what he means?
Well, I mean, I was trying to think about it, of what he actually meant by tax credit. I think that I really don't think so. Talking about specifically a tax credit, because what is the government going to do? They're going to just literally give you a tax credit at the end of the year when you come to pay your taxes. There might be something out there. That's a great question. That's something that I'm going to look into tomorrow or this afternoon and say, hey, is this something that could be done? But I don't really think so. It's more on the front end of some stuff.
I know. Okay, there's something called officer next door or teacher next door, property tax, and you get with no money down by HUD, but that's in the ghetto. I mean, you know what I mean?
Right.
Nothing's for free in this world, kind of.
Or that, like you said, the teacher credit, or like police officers that are willing to live in the district that they police. Yes, you are going to get some credits there, but that's traditionally that what percentage of consumers is that for? It's extremely small. So that is a great question. Louis, what I would say is if you are in that position, give one of us a call and we'll do the research and we'll get right back to you. And we'll do the best we can to make sure that we get the best options for you. And also, don't hesitate to call us. Anyone who's listening right now, you can see that we've got our email address up. We've got our phone numbers up. If you have generalized questions and you really want to know and you want to talk to someone experienced, give us a call. Leave a message, send a text message. We'll get back to you and we'll do the hard data and we'll find out, is this something legit? Is your question, you know, do we have a solid answer for you on your question?
Yeah,
All
we're not
right.
going to issue a pre-approval unless we can, you know, propose. You know what I mean? We don't issue pre-approval if
Yeah.
there's anything else.
All right, we got a 10-minute warning. So I'm supposed to ask the viewers to please like and subscribe below. It helps us help you. Tell your friends to like and subscribe. Post questions. Give Gustin Show Associates, the phone number's right there. 800-900-8569. I'll answer that phone 6 a.m. till 10 p.m. Central Time, 7 days a week. You can call me on Christmas. If you want a hard money loan, commercial loans, very off the wall loans like an SBA loan, or if you want to get a credit card for $250,000 with 0% interest rate, we're offering that at the lending network. That's the 866-428 loan number. That's Diane. Ask for Diane. So don't call Lending Network if you want a traditional mortgage. If you want something off the wall, you call the Lending Network. All right.
And that's exactly,
yeah.
As you can see, we not only do we do the traditional residential sign, but now we're doing a lot of like commercial stuff. So in those opportunities, reach out to us. You can see right there on mine, 385-337-4283, or get directly at me. I told a lot of people on Facebook and all of our social media to come check this out. Reach out to us. We do not hesitate. We will return your call and we will do everything we can to help you out.
We have 48
We are
states.
licensed.
We have 48 states. We don't have New York or Massachusetts. They don't want any outsiders in. We're still trying to get in there, but a lot of brokers shops have problems getting in with them, but maybe eventually we'll get them. We have Puerto Rico and we have Virgin Islands also. So we get a lot of phone calls from Puerto Rico. We only have traditional financing there. So if you're looking for a non-QM loan, we don't have that yet. But if you want a conventional owner-occupied investment, a second home, no problem. We got FHA and VA there, but no non-QM yet, and no USDA as far as I know. So let us know if you want any of those states. You can call us anytime. We're licensed all over, and we do everything. We go down to a 500 credit score. We go to unlimited DTI for VA. We do Chapter 13 bankruptcy loans for FHA or VA. We do all sorts of weird stuff that no one else does, and we do the normal stuff too. We have literally no overlays. What that means is, if I don't want to say banks' names in case I get sued, but picture a big bank. FHA goes to 56.9% back-end debt-to-income ratio. What that means is 56.9% of your income could be used for your mortgage payment and your car payment, and your credit cards, etc. A lot of these big banks will stop at 45% if you got an 800 credit score. That's called an overlay, because FHA is saying we'll go to 56.9. The bank's putting a layer of risk on there that they don't want to take. It's called an overlay. We can actually say we have no overlays because we have some banks that have the same overlays. We just go to a different bank. We have every combination of investors that we can conquer all the overlays and say we have no overlays, because we can fit you into some investors. So if VA does it, FHA does it, conventional does it, we do it. That's what no overlays means.
Right.
So that's what we
Okay,
do.
well, basically it says there's two sets of guidelines on government and conventional loans. Agency guidelines, which every single lender and their mothers has to meet. And then every lender can have additional guidelines of their own above and beyond the minimum guidelines. So basically that is what an lender overlay is. Okay, it's totally legal. So for example, VA loans, like Veterans United, for example, minimum, they're asking for minimum credit score 620 on a VA loan. All right. Well, the thing is this, VA does not have a minimum credit score requirement. We can go down to 500. Okay, as long as we get an approved eligible. So what Veteran United has is a credit score overlay. You can have overlays on pretty much everything, debt to income ratio. I mean, they can have overlays on, minimum credit trade lines. Okay. They don't require that. You can use non-traditional credit. That can be a minimum credit trade lines for 24 months. So, literally 80% of our borrowers are people that could not qualify elsewhere. Now there are certain things that we really can't help you with on a VA loan. If you got multiple late payments in the past 12 months, that's pretty much, it's not that, if you can get a loan, it's a key. You need timely payments for the past 12 months. You can have, collections, charge off, late payments, anything over 12 months, but not in the past 12 months. Would you lend anybody money that had bad credit before? Of course, but show me that you've been making your payments on time the past 12 months. So it's not like much to ask for, so anyway, I'm done.
On top of that though, what Gus always says, and what we always say is, look, you may come to us and we may see that, yeah, we can't get it done right now, but we will set up a game plan for you and we will walk you through that process. I personally probably have 8 or 9 clients that I talk to about every 30, 45 days, making sure that they're doing what they need to do and moving forward. I have a deal, I think 3 deals in the last 3 months that have been people who have come back once they've actually got where they need to be and set the guidelines that I set for them, and they followed the process, and now we're able to do something. So we're pretty tenacious. We don't give up. We may not be able to get you done right now, but we will definitely show you the way to success.
Yeah. Don't pay for credit repair. We'll take care of that for you. Okay. So on the house.
What are you talking about?
Hey, whoa.
I have to retract that statement. Credit repair is very expensive.
Dude.
We don't have the money. We're not paying for
Dude,
credit repair.
Alex is somebody that he gets a parking ticket, he thinks he's going to jail. Okay. So, just disregard him. It's like he's full of spam. All right. So.
All right, you guys, I want to say thanks for listening. And look for our next podcast next week, next Tuesday, probably about the same time. And thanks for watching, everybody, and have a good week. Thank you.
We'll see ya.